Hello and good morning, folks. Welcome back to Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. Now, yesterday we spoke about the rising concerns among the market participants about central banks going too fast and too far. Well, we have the UK Central Bank holding yesterday with their intervention in the bond markets, and I really like this bit from one of the currency market participants. She mentioned it's no longer QE or QT, it's quantitative confusion in a QC. BOE went ahead with bond purchases yesterday, changing the whole mood of market players. Yield bonds corrected. Rather, bonds across globe saw some corrections. Dollar index corrected. Euro and GBP recovered some in a volatile session, while equities also looked rejoicing. So, JK, I would want to know this complete shift of sentiments overnight. Do they look sustainable or it's just short-term volatility? What's your take?
Well, Shikhar, that's a big question, and you don't have a ready-made answer for that, nor do I have. But it's very rare in market history that you see capitulative moves across segments of the market on the same day, and even a sort of key reversal, in the same session. The day definitely will be remembered as one where the bond market punters, bear punters, were actually murdered. How else can you explain when you see more than 1.2% drop in the 30-year UK gilts? It was amazing to think that BOE actually came out with a QE plan, and the market actually initially rewarded with punishment of selling off pound and all that. But then it slowly, it was when the yield started really falling hard that the market came back to the conclusion that this was a temporary measure, and it was more in line with providing some liquidity where the buyers totally went out, and that's not a situation with which the government or the central bank would mean to have a orderly market. The statement by the BOE official was that if the dysfunction in this market were to continue or worsen, there would be a material risk to UK financial stability. So I think I will not criticize this QE done yesterday. It was more out of the special circumstances of the way the market was behaving, and it's going to be temporary. I don't see. Eventually, they will have to do the QT, which they have already started, and before that, they will have to do a lot, maybe rate hike, and ensure that markets are stable, and pound is stable as well, and also give a credible plan for the fiscal, management of whatever measures that have initiated. Yes, the treasuries overall catapulted by big buying, and benchmark 10-year yields in US also fell from 4.01 to 3.70 by the close. Currency, yes, we had this announcement of UK sending traders into a shock, and pound was pounded back to 1.0540, only to later see it make a sharp bounce to 1.0940. Clearly, BOE had carved out its game plan that the bonds is where the most illogical positions were concentrated. And once they started responding, there was a bounce in everything else, including the pound. Of course, one cannot get carried away by this short-term reaction. And UK still has to deal with the macro trends such as high inflation. Again, it was a contagious move, as we saw Euro also bouncing strongly by more than 2%. And some of it may have to do with the month-end Euro buying that we normally see. And this being a quarter end, it could have actually accentuated. And slowly, all currency pairs were in the party of reversal. And again, I see it as case of sharp profit taking due to month end and quarter end by the funds and the big traders. Chinese yuan move, of course, was a story by itself. Asian session saw it hit a multi-decade low at 7.26, a move of nearly 2% relative to previous day's low, as the Chinese central bank fixed the midpoint above 7.10, giving a field day to punters to test the limits of the band. You would have the conviction to sell the currency at levels lower than 15% from where it was 6 months ago at 7.26. And to think that China is very much a trade and current account surplus country, it's not digestible. The reversal from there has, of course, has been quite staggering, retracing the entire move up of the day and creating a key reversal once again. Many Asian players had hit a new cycle low. I mean, the many Asian currencies had hit a new cycle low, but met with resistance from the respective central banks through intervention. So suddenly market seemed to have perceived that buying dollars at 2-decade highs is not a safe haven trade after all, considering US is not bereft of its own macro issues, particularly on the deficits. Just to remind ourselves that after being in a denial mode that there is persistent inflation, Fed has not only kept the rates low, but was even buying securities at the rate of 120 billion per month and saw its assets grow to 4 trillion plus. Now harping every other day on unpalatable inflation, they are trying to suck it out to QT, and that cannot happen without a turbulence in their market as well. So things are not going to be calm. One day, is not a entire season of rainfall. So stocks also staged a strong comeback after S&P 500 had a threat of breaking through the 200-week moving average just below 3,600. Oil had jumped higher for a second day, rebounding from the losses as the US dollar eased off, and gold had some relief rally after touching 1615 and back to around 1650 plus levels. Notably, Larry Summers yesterday said, I will not be surprised to see further financial stability issues arise that demand responses. So actually his tone is slightly changing. Larry Summers is one who is being closely followed for his statements on the inflation and the way it is managed. Also, we had other Fed members who are slightly mellowing down on their hawkishness, and so that's probably giving a sense that US may be getting concerned about the contagion effect of the turbulence in other markets. We of course have GDP data today from US, which is expected to show again a negative number, minus 0.6, but that's again not being so negatively viewed because the gross domestic income has been rising. So the average has been in positive territory. So it's inconsequential, this data. Pending home sales yesterday was 2% down month on month in August, 9th drop in past 10 months, and now down 28% from the peak. So actually, the pending home sales measures the change in the number of homes under contract to be sold, but still waiting to close the transaction. So housing sector is continuing to show weakness in the US economy. So it's highly premature, to conclude that, we have seen the worst of the market stress as high inflation and geopolitical issues persist. Reminder for the latter was seen when a suspected sabotage of gas supply lines to Europe was reported, while North Korea actually fired a ballistic missile as per reports. So we are far, far away from any benignness coming into the global market. Just to touch upon the rupee, we had a gap up, touched 81.90. Sorry for the habit. So we were at 81.90 to start with, and that was very well protected due to selling from RBI, and it was a relief for the rupee when the currencies in the major space recovered after BOE's money market intervention, and we have seen rupee gain to around 81.50 as well in the NDF market. Again, don't count rupee to participate in the recovery of other currencies, even if it continues, because rupee has its own challenges, the deficits, lack of flows, and the reserves that are depleting, and the decision for postponing inclusion of Indian bonds in the index. Of course, the moves today and tomorrow will be mostly governed by half-year end considerations. So we'll have a real trend emerging in the coming week, actually. Yeah. Thank you, Shikhar.
Okay, wonderful, JK. I really like the commentary today. I mean, the kind of expectation that market is having currently is quite choppy, and I mean, it can be expected that sudden shifts in stance from the central banks can definitely change the mood of the market participants. But I really like that you mentioned that the current turn of events or the current QE, it looks temporary, and eventually the central banks have to move back to QT to tame the animal in the name of inflation. And folks, we are far away, as JK mentioned, from the benign expectations of the market, and as both the inflation and geopolitics have not rested, and they continue to dwindle with the markets. The turbulence is here to stay, and therefore, we expect everyone to keep risk management as one of the key aspects to look after. We are in a phase where there is month end and half yearly profit taking into place. There are flows coming in and out with respect to different currencies and assets. So folks, we can keep seeing some volatile moves and probably some new trend emerging after the close of this half year of fiscal and 3 quarters for the calendar year basis approach. We come back again tomorrow morning with another round of update. That's it for today, folks. Thank you so much for listening.